Gold just hit levels we haven't seen in history, trading near $4,339 per ounce. But here's what Wall Street isn't telling you. Goldman Sachs, Morgan Stanley, and JP Morgan are all predicting gold could surge to $5,000 in 2026. That's a potential 15% gain from here. But this week, the charts are showing something critical that could make or break your trades. Major banks are repositioning, central banks are buying record amounts, and one key resistance level at $4,381 stands between gold and an explosive breakout. In the next few minutes, I'll reveal the exact levels to watch, the hidden patterns the smart money is trading, and 3 actionable setups you can use this week. Whether you're bullish or bearish, this analysis will save you from costly mistakes in what could be the thinnest, most volatile trading week of the year. Stay with me because Part 4 includes trade setups with precise entry points and risk-reward ratios you won't find anywhere else. Let's dive into the gold market analysis for December 22nd through 26th. Gold is ending 2025 in unprecedented territory, currently trading around $4,339, just shy of the all-time high of $4,381 reached in October. This represents a staggering 67% gain year to date, making gold one of the best-performing assets of 2025. The past week saw gold consolidating in a tight range between $4,300 and $4,355. Friday's session closed around $4,347, with the metal defending the psychologically critical $4,300 support level multiple times. This consolidation is happening in the face of 2 opposing forces, a strengthening US dollar and rising Treasury yields on one side, versus persistent safe haven demand and Fed rate cut expectations on the other. 3 major themes are dominating the gold market right now. First, central bank buying remains historically strong. JP Morgan estimates central banks could purchase 585 tons per quarter in 2026, far exceeding the 350 tons needed to maintain current price levels. Second, gold ETFs have seen massive inflows, with approximately $77 billion pouring in this year, adding over 700 tons to holdings. Third, and perhaps most significant, major financial institutions are upgrading their 2026 forecasts dramatically. Goldman Sachs now targets $4,900 per ounce by December 2026. Morgan Stanley sees $4,800, while HSBC suggests gold could spike to $5.00 in the first half of next year. But here's the catch. We're entering the final full trading week before New Year, which means European holiday closures and significantly reduced liquidity. This creates both opportunity and danger. Price swings could be exaggerated, stop hunts are more likely, and volatility could spike with little warning. Understanding this context is crucial for your trading decisions this week. Let's break down the technicals because the charts are telling a compelling story right now. Gold is trading within a well-defined ascending channel on the 4-hour time frame, and this structure has held beautifully throughout the recent rally, starting with resistance levels The immediate ceiling sits at $4,360 to $4,381. This is the weak high zone and the 2025 record territory. Price has tested this area multiple times without a clean breakout, suggesting strong selling pressure or profit-taking. Above that, we have a liquidity sell zone at $4,433, and if bulls really take control, the upper channel boundary sits near $4,465. On the support side, $4,315 to $4,320 is proving to be solid ground where buyers consistently step in. The critical psychological level is $4,300, which has been defended aggressively throughout December. A break below this would likely trigger stop losses and could send gold down to the stronger support zone at $4,250 for dollars to $4,278. This deeper level represents a key order block where institutional buying interest is expected to emerge. The trend indicators are painting a mixed picture. Moving averages show a clear uptrend with price trading above the 50-period, 100-period, and 200-period averages. However, the RSI is hovering near overbought territory around the resistance zone, suggesting momentum may be exhausting. The MACD still shows a bullish crossover, but the histogram is flattening, indicating weakening momentum. Wave structure analysis suggests we may have completed wave 5 of the current impulse, which typically signals a corrective pullback before the next leg higher. The triangle continuation pattern that formed earlier in December has been confirmed with a break above $4,245, supporting the bullish case long term. The fundamental backdrop for gold remains extraordinarily supportive. And here's why this matters for your trades this week. The Federal Reserve's policy trajectory is the primary driver. Markets are currently pricing in at least 25 basis point rate cuts for 2026. Lower interest rates reduce the opportunity cost of holding non-yielding gold, making it more attractive relative to bonds. Geopolitical tensions add another layer of support. Reports indicate Israeli officials are planning to brief President-elect Trump on potential strikes against Iran. Any escalation in Middle East tensions would trigger immediate safe haven flows into gold, potentially pushing prices through that $4,381 resistance level we discussed. The economic calendar this week is relatively light due to holidays, but that's actually a concern. Thin liquidity means any headline, whether it's a geopolitical development, unexpected economic data, or even a single large trade, could create outsized price movements. This is a double-edged sword, opportunity for quick profits, but also heightened risk of stop-outs. Here's my forecast for this week. I expect gold to trade in a $4,280 to $4,380 range with a 70% probability. The base case is continued consolidation as year-end position squaring occurs. There's a 20% chance of a bullish breakout above $4,381 if geopolitical headlines intensify or the dollar weakens sharply, potentially targeting $4,433 to $4,450. The bearish scenario carries a 10% probability of break below $4,000. 300 would likely drive a correction toward 4,000 to 150 for dollars. But I view this as a buying opportunity rather than the start of a reversal. Given the overwhelmingly bullish long-term fundamentals and institutional forecasts targeting $5.0 next year. Now let's talk actionable strategies you can implement this week. I have 3 setups, each designed for different risk profiles and market scenarios. Setup number 1. Buy the dip strategy. Wait for a pullback to $4,300, $4,315 support. This is my preferred entry for swing traders. Place your stop loss at $4,000 to $185. Target take profit 1 at $4,350 for a 1-to-2 risk-reward ratio. Take profit to it $4,380 for 1-to-3. And if you're aggressive, target $4,433 as your extended goal. Position sizing should be 1 to 2% of your account given the holiday volatility. Setup number 2. The premium fade. This is a counter-trend trade for scalpers. Only trigger this if price reaches $364,378 and shows clear rejection with a break below $4,309 on lower timeframes. Your stop goes at $4,390, targeting $4,320 for a quick scalp, or $4,000 to $180 for the full correction move. Setup number 3. Breakout trading. For the momentum traders, a confirmed break and close above $4,381 is your bullish signal, with stop at $4,360 and targets at $4,433. Conversely, a break below $4,300 triggers the bearish setup targeting $4,000 to $150 for dollars. Critical reminder: reduce your position sizes by 50% this week due to holiday liquidity conditions. Don't chase moves without confirmation, and widen your stops to avoid being shaken out by erratic price action. If you found this analysis valuable, smash that like button and subscribe for weekly market breakdowns. Drop a comment below with your gold forecast. Are you bullish or bearish for this week? And check the description for links to my technical charts. Trade safe, manage your risk, and I'll see you in the next analysis.